It's time for me to welcome to our cast of stars here on stage, the Chief Economic Advisor, Anantha Nageswaran. Mr. Nageswaran, if you could join us here on stage, please. Ladies and gentlemen, a big round of applause for the Chief Economic Advisor, Anantha Nageswaran. Mr. Nageswaran, many thanks for joining us. You know, before I talk to you about the domestic factors, let's talk about the changes that have happened overnight globally. And let me begin by asking you about what you make of the commentary that's come in from the Fed Chief Jerome Powell, stating that perhaps the first signs of a disinflationary environment. How comfortable does that make you feel, especially in light of the global uncertainties that we are faced with? Yeah.
So he, of course, did mention the fact that temporarily, or at least for now, inflation pressures have eased. But he also mentioned that they are very determined to reach their 2% target, and they are committed to further rate increases. But the financial markets took a different view of his press conference. So that is what bothers me, because financial markets, having been conditioned over 2 to 3 decades in a different manner, or are refusing to believe that this Fed would want to see the inflation rate come down even further and would be poised to tighten. So the more they kind of engage in this eyeball-to-eyeball confrontation with the Fed and expects the Fed to blink first, and if the Fed doesn't, then the amount of rate hikes that will be required will become even more than what would be the case otherwise. That is what bothers me from the emerging market and the Indian angle.
And which is why you talked about entrenched inflation and the possibility of a longer tightening cycle as well in the economic survey. But that's one of the global factors. The other global factor that I want you to comment on, and I don't think that we've discussed that enough, especially since we've been poring over the budget, is the impact of what's happening in China. The reopening, bouncing back as far as manufacturing is concerned, the PMI in China coming back to about 50, under that is of course contraction. The implications of China reopening in the way that it has on the global economy, and what it eventually will mean for India as well.
So obviously, given the size of Chinese economy, whatever happens there will have a global impact, whether it's a slowdown or an expansion. And to the extent that if the recovery happens to be smoother, then definitely it would have it would impart an upward pressure on commodity prices. Including it will create a higher demand for crude oil. So therefore, we have to factor that into our calculations going forward in 23-24. So the speed with which Chinese economy returns to normal and the magnitude of the bounce from last year's growth rates will definitely have a material impact from the point of view of global inflation and from the point of view of commodity prices. So in fact, it could even prolong the monetary tightening cycle in the Western advanced economies. So that is something we need to watch.
Yes, we need to watch that. And so a slowing global growth is in fact advantage to India.
Slowing global growth would be what the doctor would order for India.
Would be what the doctor orders for India. If there are any questions here for the Chief Economic Advisor, do raise your hands and we'll try and get a microphone across to you. But please keep the questions relevant to the CEA. Yes, sir, go ahead.
Hi, my name is Anil Advani. There's one particular question that has been bothering me and I've never got a right answer for that. These FIIs that buy stocks in our country in the secondary market results in a lot of forex coming to our country. But none of the FIIs come with the intention of making less than 20-25% return on their investment. When this money comes in, the dollars come in, RBI absorbs these dollars, rupee gets into the market, inflation resulting in inflation. RBI absorbs this rupee by issuing bonds, borrows at about 6 or 7%, and then onward puts these foreign currency in US bonds, which earlier were yielding about 1 to 2%. So this whole benefit of getting FIIs to invest in our secondary market, I somehow have never understood. Has there been any data that how much money has come in by these FIIs in our markets, and what is the current value of that investment? So if let's say $1 billion came in and it is worth about $5 billion, whether the whole exercise was worth it?
So if you look at the data available from RBI and the national NSDL or CSDL, you do get data on the FII flows at cost. But if you want to know what is the value, current market value of these FII flows, then there is a separate table in the SEBI website, Assets Under Custody, that would provide you the market value of the current FII holdings.
Well, you know, that I think is very helpful advice that's come in from the CAA on where to actually source information, where to look for information. But CAA, you know, on the issue of markets, and I want to address this with both you as well as the DPAM Secretary, and it's been a fairly volatile last 24 to 48 hours as far as the markets are concerned. I want to link this back to you know, your point that you made about the indigestion having been worked out of the system. Bank balance sheets are looking strong at this point in time. Corporate balance sheets are looking strong, and which is why you believe that we are on the cusp of unleashing the animal spirits in the economy. But would you be concerned, and I don't want to draw you into any specifics, but would you be concerned about the kind of exposure that large conglomerates have to the banking sector at this point in time?
Based on the information we have, it doesn't look like at this point it has got the potential to derail the beginning of a new financial cycle.
Okay, so you don't believe that that is the case at this point in time? Okay. Outside of, you know, the global risks that we spoke of, which of course have to do with interest rates and inflation, and there are many imponderables there on how things will actually pan out given the geopolitical scenario at this point in time. What are the other factors that you're going to be watching for, both in terms of, you know, what could move the global markets and then thereby impact India? So,
I mean, as I mentioned in the survey as well, almost 100% of the risks to our scenario for India's growth and inflation in the next financial year, almost all of it come from external factors. One is geopolitics, of course, how the ongoing conflict in Ukraine would pan out, both in terms of its duration and in terms of the intensity, and what kind of impact it could have on both crude oil price and also on supply chain disruptions. And second is the entire monetary policy tightening cycle and the strength or the weakness of the dollar. All these things would be key determinants of how our not only our growth and inflation play out, but also on how our external balances evolve in the course of 23-24. So as far as I can see, pretty much at this point, I do see predominantly external factors being able to shape or mar the kind of assumptions we have with respect to our real economy in the next financial year.
I'll come to, yes, sir, we'll get a microphone across to you. If you can stand up, it's easier for them to spot you. Go ahead.
So I had one question. I run a large fintech platform headquartered out of New York. And one thing which is happening right now in US is the Inflation Reduction Act is actually a misnomer. It's for clean energy. You know, US is going to like massive amount of tax incentives coming in, so much so that even the EU is extremely worried. And what's starting to happen, we are seeing that, you know, that we fund a lot of businesses out there, and we are starting to see a lot of European companies even starting to shift their manufacturing over to US right now. And I don't see any like even debate in India around it, that how India is going to compete, you know, in that. And coming to the DPM Secretary, what Shireen had asked about the banking privatization. So what the government is doing with fintech platforms like us is that we are launching a lot of the tax credit financing programs right now for businesses who are setting up the units, because it takes time for them to get the tax credits back from the government, and the government wants it to happen and so that there's no fraud. The problem we have been interacting with Ministry of Finance also has been that because of lack of any legislative reform on the side of banking privatization, none of that can happen in India right now. So that clearly means that we won't be competitive both in manufacturing of clean energy, and we won't have the capital that is required, because the debt capital cost in India is so high today that if we have to compete in the world markets, then we need to have that debt capital also be available.
Sure.
And in US we get it from everywhere. Europeans are coming, you know, you name it, everybody is coming to finance that, right? Because that's a pretty safe kind of investment on the debt side, you know.
Sia, would you like to take that up?
No, I think I'm not really particularly, you know, convinced about, you know, because we have both private banks operating and the public sector banks operating in Indian space. So how is it that the privatization is linked to a particular business of fintech not being done?
GST was brought up here by the DPAM Secretary, and I want to understand what you believe the roadmap could potentially look like. You know, no one's now talking about rate convergence at all at this point in time, even though that was what the aspiration was, that we had too many rates and we should simplify the GST regime. More importantly, as far as the revenue neutral rate is concerned, your predecessor had put forward a revenue neutral rate. We're nowhere close to that at this point in time. What do you believe is the roadmap as far as GST is concerned? Should we just leave it where it is, because you know the government is happy with collections that are coming in at over 1.5 lakh crore rupees for now, so don't spoil the party?
No, the government is aware that there has to be a GST 2.0, but we have to understand that in the last 2-3 years we have had these one-off shocks which obviously have distorted the speed with which the system becomes familiar with the GST regime. Therefore, we need to allow the system to settle down and become familiar and comfortable, which is what is happening right now, such that the average collection per month is slowly stepping up from 1 lakh crore to 1.4 to 1.5, etc. Whether there has to be only 1 or 2 or 3 rates can be debated ad nauseum. But when you have a country which is in a transition from lower middle income to middle income, etc., the path of GST settling down into a fewer rates than what we have will also take longer than it takes for us to debate this. And yes, the revenue neutral rate has come down, but at the same time, so far, if it leads to higher compliance and better transactions and better tax revenues for the government and greater efficiency, then probably we need to also update our estimate of what the revenue neutral rate is.
Okay. The second question that I had for you was to do with states. And we spoke about capex, central capex, which is at a 19-year high at this point in time, but the government is also incentivizing states to spend and supporting the states as well on that front. In your assessment, especially after the fact that the GST compensation window has closed as far as states are concerned, what is your own assessment of the fiscal health of states at this point in time, and hence their ability to also go forward with the reforms as well as capex spend?
So, based on the revised estimates for 22-23, we do see that states are absorbing about 80% of the interest-free loan that the union government provided for capex in 22-23. And we understand that as of now, the 22-23 state combined fiscal deficit would be probably around 2.4% of their GSDP, which is roughly 1% lower than what was expected. So on the face of it, I think states are doing their bit to consolidate, but we are also aware of the underlying issues of contingent liabilities, of power tariffs, viability of the power generation and discoms, etc. And now some of the states have indicated their intention to move back to the old pension plans, which will show up in their numbers 10 years down the road, etc. So there are underlying issues, but as of now, given the impact and the disturbance that COVID caused, states at the moment are on track to get back to a fiscal sustainability within the short-run parameter, while definitely I acknowledge that there are longer-term issues that need to be addressed.